Hello and welcome to Buy or Sell, Equity Mate's newest show dedicated to bringing you the hottest ideas in markets. I'm Ali Selby, and unless you've been living under a rock, you've probably noticed it's been incredibly volatile this year. It feels like every time we get a new tweet from Trump, the status quo changes. So what if you could invest in a few bottom drawer stocks that could really help you sail through this storm? Well, to do exactly that, we're joined by Jun Bei Liu from TenCap and Anthony Aboud from Perpetual for their analysis of stocks that could be real portfolio staples. First up today, we have Australia's biggest bank and actually biggest company, which is Commonwealth Bank. Jun Bei, I'm going to start with you. It's not cheap. It's trading on a forward PE of around 27 times. Is it a buy or sell?
Within the sell camp, it's not to say that the company is not good. This is actually, a very, very high quality bank. Probably the highest quality bank here in Australia, but probably not in the world. It is the most expensive bank though in the world.
I know,
so the valuation
crazy.
is really, really high. So I think, when you ask us as investors, do we think buy or sell? We tend to think relative to the share market because our benchmark is the ASX 200. I think the CBA will underperform the 200. I'm a seller of CBA. Our share price is too high, even though it's well run. We do think the underlying operating condition is going to struggle somewhat, but probably will do better than other banks. But I think the earning has done incredibly well. From here on, we're probably going to see that flatlining.
Okay, Anthony, over to you. Is this your favourite bank? Is it the best bank in the world?
It's a very good bank, but look, it's very hard for me to recommend anything but a sell. I think it's a very well-run bank. I'll give you the bull argument. It's a very well-run bank. They're probably going to be able to take a lot of costs out through AI. I mean, if you think about where AI can take costs out, it's going to be in white-collar jobs where there's process-oriented jobs. CBA is the leader. They've transitioned 15 years ago from mainframe to cloud, whereas all the other banks are still sort of chasing the tail there. So they are the best of the Australian banks, and I think they're very well managed, and there's going to be a lot of cost-out opportunity for CBA. So that's the bull argument. And we're going to be in an environment, I reckon, in the next sort of 6 months, there's going to be a lot of downgrades, and CBA probably doesn't downgrade. So, short term, it's, I guess it's looking okay. But longer term, it's too expensive, 27 times, 4 times book. And look, at some point in time, all these job losses in white collar is going to hurt their the credit quality of their mortgage book. And so that's probably 4 to 5 years from now. But narratives are what drives share prices, not actual earnings. And so feel that, it's probably there's asymmetry on the downside on this one.
Okay, not a bottom drawer stock. Next up, we have Solpats. It's been dubbed the Berkshire Hathaway of the ASX. It's very diversified. It has solid dividends. Is that one a buy or sell?
I've still got it as a buy. I think they've done a lot. They've really transformed this company, and they've really modernised it. They've collapsed the cross-shareholding structure with Brickworks. And I feel that, yes, NAV's 36 and stock's trading about 42, 43. So it's trading at a premium already. But if I look at this company in 4 to 5 years' time, I do feel that they will buy some good quality companies. They've got some really high-quality talent on the board, including Vic Bansal, who will be very hands-on and be able to buy some good industrial companies. And we think either turn them around or be a cash flow generator. These guys have generated low double-digit returns over decades using old
and dividend
school
growth every year, I think.
Absolutely. So yeah, it's a bottom draw stock. We like it.
Okay, it's actually quite cheap now. It's trading on a forward PE of 10 times. It has had a very volatile 12 months, but its share price has ended up 19%. Is that a buy or a sell?
Look, that's a buy. I do think it's a bottom drawer stock as well. Just looking at its execution over the last few decades, it's been incredible. This business, I think, when the company explain, what they are and who they are, what they want to be is essentially they say we're like a family office. We invest our family office, our family money in this way. And, we're looking for sustainable return. We're looking for dividend. We're looking for all of that. And then they say, why don't we just take it as a listed vehicle? And they have done that for many years. And then the management team has been incredible, and also now taking, simplifying the structure and allowing more access for investors that are actually participating in that trend. They also have a lot of access to a lot of deals and, other structures. And so I do think this company is very well positioned. And also their ability to hold on to asset because they hold on to asset that's, for many years without the need to liquidate them and looking for the right value point to exit them. I think that's quite incredible. One example is the coal asset. They sat in there for many years. If they were forced to sell, like many other investors a few years ago during the ESG transition, then it wouldn't have delivered the value it has as it is today. So, I think it's definitely a buy.
Next up today, we have Rio Tinto. It has iron ore, copper and aluminium exposure, among other materials and minerals. Jun Bei, is that one a buy or sell?
Look, it's a buy. With all the components of its commodity exposure, we think most of them that exposed to are heading higher with a number of reasons. One is structural for copper. We do think the demand for copper is structural. We think the aluminium price is heading higher because of disruption now created by the Iran war, because of the smelter that's been damaged. And then we think iron ore is holding okay because China, if anything, actually seems to be turning the corner somewhat. Not all firing, but China, in terms of the growth seems to be stabilizing. Its consumer is doing a bit better, real wage growth coming through, and its share market is doing a bit better in terms of optimism. So I do think that iron ore is looking pretty reasonable. So net, I think that company is well positioned and looking pretty positive.
It's already done extremely well over the last 12 months. Its share price is up 58%. Do you think that can go even higher? Is that a bottom draw stock? Is it a buy or sell?
Yeah, look, I always worry about having resources as bottom draw stocks. I think you always got to trade them cyclical, at some point.
Yeah.
But I do like it. I got it as a buy. And for all the reasons Jun Bei said, as far as whether it be copper or aluminium, there's some good structural growth elements there. I do like the management. I mean, I think they're bringing in some hard-nosed return type drivers, cost out, really critically looking at all the capital they're spending, which I think is quite refreshing for a big lumbering company like Rio. So we do like the CEO. Stock sort of really got held back when they made the Glencore bid, but at the end of the day, I think they've moved on from that. And so we think it's a bottom draw buy.
Okay, we're going to take a quick break and then we'll be right back. Let's get back into it. We asked you to bring along a bottom draw stock today, something that can help sail investors through this volatile storm that we're seeing. What have you brought for us? What's your portfolio staple?
Olive oil.
Olive oil, yes. We always need olive oil.
Well, look, it's healthy, but there's a company called Cobram Estate. If we rewind the clock 15 years ago, Australia imported pretty much all of its olive oil from Southern Europe. Cobram started by pretty much buying out of bankruptcy the Timbercorp plantations.
Really?
Yeah. Now, in Australia, where 40% of our olive oil we consume is domestic, of which about 3/4 is grown and bottled and processed by Cobram Estate. And so this is a company which has gone from virtually nothing to made $110 million EBITDA last year. What we like about the Australian business is that they've spent the money on the plantations. It takes 4 to 5 years before they mature. And so without much further capital spend, as that matures, they're going to be able to grow that to maybe $170, $180 million of EBITDA just in Australia. And that's something which we like. On top of that, the same story is happening in the US. They've been going hard in the US, but in the US, 95% of the olive oil is imported from, again, Southern Europe.
Wow.
Only 5% is grown in California. They've now bought the biggest player and are pretty much 90-odd% of that 5%.
Wow.
And so that's going to continue to grow. It can be the same size as Australia over the next sort of 5 years. And so this is a company which I think the earnings could easily go from about $100 million now to about $350 million in 5 years' time. And I think there's some good long-term structural growth drivers, including people's focus on their health. And so transitioning away from seed-based oil to olive oil, to olive oil. And in the US, for instance, the consumption of olive oil per capita is about less than half that of Australia. So
yeah, I can't imagine they're having a lot of healthy olive oil in the US.
So that's my bottom stock draw, CBO, which is Cobram Estate.
Okay, over to you, Jun Bei. What's your bottom draw stock?
Well, my bottom draw stock is Cuscal, coded CCL. And now this company is a digital payments infrastructure business. It's only just listed for the last year and a half. And this company essentially clips a ticket for every single digital transaction that goes through on different platforms. Now, we know there's many different payment companies, the Tyros, the others, and, so many different ways. We like to participate participate in that digital transaction. So why not just invest in the actual infrastructure? This company actually originally formed by a group of regional greater unions and regional banks as their way of competing with the largest banks. So they even today still remain large holders of this company. But by them coming together, building a platform, it is now one of the largest one outside the big four banks in providing that service. And we all know today we're spending more and more in digital payments, and then the government just came through and said they're going to reduce the transaction cost as well. Again, further encouraging people using the digital pay. This company is very well positioned, double-digit growth for many years, and then for the next few years, we're still looking at least 20% growth for the next few years to come. Aside from the organic growth that is taking place with us using more digital payment, there is actually a lot of acquisition opportunities, bolt-on acquisition opportunity. So this company last year made an acquisition, and it was 40% accretive because of the vertically integrated nature of the acquisition, and then the smaller bolt-on nature of it. And they just made another acquisition, and it's going to be again earnings accretive. So there's a lot of opportunities to come aside from the organic opportunity. So for us, this company trading at a sub-market multiple now at 15 times next year.
Wow.
I think for the growth it's delivering, it's looking very, very strong. And one more thing, remember when companies get included in the ASX 300 and the like, those index, and the share price go through a bit of run, this one is looking very, very likely to be included in the next index inclusion in the 300. So 300 is the small order index. So, we think it's this up-and-coming emerging leader that will, have everyone notice very soon.
Okay, well, that was an exciting end to the episode. Thank you both so much for sharing your ideas today. I really enjoyed that episode, and I hope you did too. If you did, please like and subscribe wherever you get your podcasts, and leave us a comment to know what stocks we should analyse next. You've been listening to an Equity Mates Media production. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. If you're unsure, please speak to a financial professional. The host of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under Australian Financial Services Licence 540697.